Hello and welcome to our 2026 Client Classic.
2026 marks our 20th year in business, and we couldn't have made it this far without your support and trust.
2025 was hectic to start. We began the year with the office remodel, had some first quarter volatility, and our own family struggles. Yet by year's end, I would say it's been one of the most rewarding in our 19 years in business. And we thought it was timely to create this yearly webinar, which we plan on doing every year going forward as a way to first, thank you for your business. Secondly, review what we've implemented that enhances the client experience. And lastly, preview what is coming in 2026. We've chosen to use a baseball theme, hopefully leaving you feeling like fans of our practice and show that we're committed to providing an old school service model by leveraging new school technology. And as a token of our appreciation, for everyone that's on this call, you're going to get a little gift card to a local coffee shop. Treat yourself. Over to Richard to review the agenda.
Now, let's review our agenda. First, our team introductions, recap of 2025, what's coming in 2026, and our amazing market outlook by our Chief Investment Officer, Gene Goldman.
For those of you who don't know me, my name is Josh Feller, and I've had the pleasure of founding Feller Financial Services for the past 20 years. For those of you who couldn't tell, I'm not originally from Florida. I grew up in a small town called Voorhees next to a big town called Cherry Hill, right next to a big city called Philadelphia. I am a massive, massive Philadelphia sports fan. My education was at the University of Connecticut, and after graduating in 2005, I came down to Boca Raton, met my business partner, Richard Koblick, and we've ran Feller Financial Services for the past 20 years proudly.
I'm sure everyone knows me, but for not, my name is Richard Koblick, co-founder and vice president of Feller Financial Services. I'm originally from Berkeley, California, went to the Florida State University, and fun fact, I am a two-time Ironman triathlete finisher, and I play hockey 3 days a week. Kim Toscano is our office manager and has been with us for 15 years. She is the backbone of our office. She provides old school service, handles managing our office, taking impromptu client requests, preparing tax documents, scheduling meetings.
And I have had the pleasure of working with Crystal for the past 5 years. She is the engine behind the marketing growth that you see. She helps manage all of our social media accounts. She's responsible for our brand new website, and she is your go-to person if you have events that you would like us to participate in.
Christian Coppola is a licensed advisor that also runs our processing, including ensuring client transactions are done timely, efficient, and accurate. He works with clients and has begun to work with several of our clients' children that are starting in their financial journey.
And we're proud to have transitioned Dylan from an intern to a licensed advisor this year. And he works hand in hand with Christian in helping with processing. He completed all of his client training in 2025 and will begin working with clients in 2026 with Christian. I have to mention, both of these gentlemen are fantastic places to send your children if they're beginning on their financial planning journey. Right into introducing Marie. Marie is our lead intern. She ensures that all of our data is clean. She handles any ancillary business that our processors, Dylan and Christian, need, and she helps Crystal in that beautiful marketing design that you see.
Hannah assists Marie with data entry and client maintenance, responsible for social media outreach, and attends Florida Atlantic University.
Looking back at 2025, it brought us to an original idea in 2020 during COVID of enhancing the client experience by adding new school technology with the old school service that you've become accustomed to. We have a saying around our office, what is good for our clients has to be good for us. And we know that with all of this new technology being implemented, it can be overwhelming. But there's a reason why we've added these programs. We want our clients to worry less and enjoy life more. And we felt it was important to take a second, review the different programs that we're using, both internally and externally, and the underlying value that each has on your decisions and experience. Right in the beginning of 2025, our website provider was actually purchased, and I'm so happy with the way the new website came out. It's a central hub for everything. It's got education. If you need to know where to view online, we have an online portal. It has all of our contact information, and there's some fantastic surveys and quizzes. And by the way, it's a great place to refer friends to that might be interested in our service. Some of you might have noticed that every quarter we've been sending a newsletter. This is our Palm Tree Quarterly, and we're really proud of it. It's based around 3 major topics. We're going to give you an update on the office, update you on pertinent market content, and also update you with programs throughout the year. If you haven't been getting these newsletters, there's a good chance that they're in spam, so keep an eye out for that.
AdviceWorks is where we're going to review our accounts and have access as our main client portal. We want to remind clients that the app is available on their mobile devices. All Pershing statements are loaded directly in there, access to view all accounts on the same screen, and have the ability to link outside investments, and more to come in 2026. Over the last decade, identity theft and fraud crimes have substantially increased, and we have seen many clients firsthand that have been affected. To keep our clients protected from such activity, we introduced Careful in 2024 and purchased 100 free subscriptions. I'm proud to say that we expect by the end of first quarter to have reached and maxed out the first 100 subscriptions. Due to the impact we've seen, we are entering into a long-term relationship with Careful by adding another 100 free subscriptions. If you have programs like LifeLock or maybe protection through an insurance company, that's fantastic. If you are not utilizing any fraud protection, I highly recommend it in today's climate because it allows you to protect your money through money protection, have your bills organized, identify and care credit monitoring, secure sharing, home title monitoring, document and password storage, and more.
One of the cornerstones of our practice are those client reviews, and we really enjoy getting to know about your households. Reviews will continue to be enhanced by utilizing technology to create a clear and concise retirement picture, an easy-to-view understanding of your investment strategy. And to do this, we've integrated 2 different softwares that I'd like to briefly highlight. First is Nitrogen. Nitrogen is going to provide a great risk tolerance analysis, GPA portfolio snapshot, so you can see how you're performing compared to others, investment reporting, and risk-tested scenarios. Things like what if there's a bear market, interest rate changes, and a bull market. Now, this integrates with eMoney. eMoney is our financial planning software. It's where we capture goals, run different scenarios, help with budgeting and cash flow, and can answer those what-if scenarios. It also has a great ability to answer those important questions. Things like, what are your probability of success? What's the maximum retirement income you can earn? What's your earliest retirement date? Projected inheritances, and a lot more. And we are beyond excited about the potential in the behavioral finance space. It means we can know you better, as in not just your money, but what drives your decisions about money. Now, it's not mandatory that you sign up by any means, but Atlas Point is a truly next level boost to the partnership between us, the advisor, and you, the client. And here's a high-level overview in a visual on the screen. And if you're wondering what's a bull, what's this all about, just take our financial virtues quiz and uncover something maybe you didn't know about yourself. And by the way, it's fantastic for couples. You can see where you kind of overlap and where you differ in your financial tendencies. These links will be available in all client reviews and are also available right on our website.
Looking forward to 2026, as we turn over our calendars into this new year of 2026, we wanted to continue our mission of old school service and new school technology, and have some exciting plans for both. We thrive on client interaction, and the biggest compliment that we can receive is getting a phone call from a friend, a family member, a colleague that you feel may need our assistance. We wanted to make that transition easier in 2026, as well as speak to enhancing the client experience and offering internally with Feller Financial Services. For 2026, we're going to have smaller events. First, we want to be involved with you and your local groups, and have probably haven't done a great job enough of articulating that since COVID. We miss seeing you and all of your lovely faces. And last year, we started to get back into small, intimate gatherings. If you have a small group of friends that get together frequently, like the one in this picture on the right, we want to take you and your friends out to lunch and just be available for questions that people have. Let's do it. Do you have a charity that you are passionate about and want our support? Please let us know. Or do you have a group that needs financial education? We are there. Most of you remember that for the first 15 years in business, we held an annual client event. It was something that over the years we looked forward to the most. But by the time COVID hit, the event had grown to over 200 clients that attended, and after the shock of the pandemic, we pondered how to reintroduce this event responsibly back to you, our clients. That leads us to our inaugural event I'd like to announce. In the fall of 2026, we are going to be planning a family gathering for all families and friends of Feller Financial Services. This will be a lot more casual, open, food-friendly, and more inclusive than the old Feller Financial Services client events that some of you remember. So bring your children, bring a neighbor, bring a friend, and enjoy a nice afternoon filled with great conversations, terrific food, and entertainment with us.
And I am so excited to present Wealth.com. Last year, Cetera approved a high-end estate planning solution for advisors to be able to use with our clients. Over the past year, we've inquired the need for such a service, and the feedback was astounding. So in 2026, Feller FS is proud to announce our partnership with Wealth.com. Now, for those of you not familiar with Wealth.com, they're a competitor of a company like Trust and Will. And by leveraging their technology and team of attorneys that work on the back end, we expect the positive impact to clients in the following ways. If you have documents, Wealth.com can take those multi-page estate planning documents and summarize them within minutes. From there, we're going to store that summary and review it with you on your next client review. Now, for those of you who've used attorneys that we've recommended, we are working on getting this summary in your files for your next meeting. Now, let's say you don't have documents. We'll be able to offer a solution. The way we look at it, there's 3 ways you can create estate planning documents. Number 1, you can do it yourself. Number 2, you can work with an attorney. And now you can work with us hand in hand to help you build, review, and change documents. If something changes, say you move out of state, have a new grandchild, find a new charity, we can review the existing document and make proper idea suggestions and help execute the changes if needed. And lastly, we can offer a high-end estate planning solution at a discount to your loved ones. I am honored to have our Chief Investment Officer of Cetera, Gene Goldman, join us today with a special market review. Gene is responsible for the strategic direction and growth of Cetera's research offering. He's got over 26 years of experience in development of investment strategies, money manager research, and overseeing investment analysts. National media outlets like Bloomberg News, Forbes, The Wall Street Journal regularly request his insights, and he's often a guest on CNBC and Fox Business News. Without further ado, please welcome Gene Goldman.
Hey, thank you, Josh, and thank you everyone at Feller Financial. So as Josh said, I'm Gene Goldman. I'm the Chief Investment Officer for Cetera Financial. Welcome to my presentation. Today, we're going to talk about our 2026 annual market outlook. And really what we're calling it is economic resilience meets elevated expectations. So in simple terms, what that really means is that market valuations are high, expectations are very high, but the economy is resilient, but really is it as strong as the markets are suggesting? So I know it sounds a little cautious, but we'll talk a little bit about this. So my presentation today, I'll talk about the economy, I'll talk about the Fed, I'll talk about financial markets, and of course, I'll talk about what to do. So with that said, as we do every year, we will cover 3 investment themes. And these 3 investment themes are what we feel drives the economy and the financial markets for the entire year. These are very broad-based. These are very, very sort of what we think will be the big key drivers. So the first theme that we laid out for 2026 is simply this: the economy proves to be stronger than expected. You know, a lot of data that we've seen at the end of 2025 suggests that the economy is slowing, maybe headed to a recession, maybe data is weakening. We just don't see it. We see the economy is going to be a little bit stronger than expected. I'll talk about a few reasons why. Second of all, here's a little bit of bad news, but not really that bad, is that market returns are going to be below average. If you look historically for the stock market since 1933 has averaged about 9.3%. We do think returns will be less than that, maybe in the 4 or 5 or 6% range, because expectations are super high right now, and it's really hard to live those expectations. And then our third theme is that equity leadership changes. If you think about the stock market over the last few years, everyone has been focused on these big mega cap, these AI companies. We do think there are some great companies in those areas, but we do think the rest of the market starts to catch up a bit, which is actually really good news. We think areas like small cap, mid cap, value, things that people have forgotten about will start to come back and do well in this type of environment. So with that said, let me dive into each of these one at a time. So the first theme, again, is stronger than expected economic growth. So most believe that economic growth, GDP, gross domestic product, which is a measure of our economy, should be pretty similar to what we saw in 2025. However, we do think there's going to be a little bit of an upside surprise, and there's a few reasons why that the economy could be a little bit better than expected. So let me dive into some of these reasons. First of all, tariffs. Tariffs are the story for 2025. And for the most part, tariffs have been implemented. But the good news out of tariffs is that revenue that has come from tariffs has been used to finance the Big Beautiful Bill, for example. So the Big Beautiful Bill came out in the middle of 2025 and introduced several tax cuts that were retroactive and effective from January 1st. However, keep in mind, this is very important. The IRS did not adjust tax withholding rates in 2025. So you think about this. The IRS saw that tax rates were being cut, but they kept the withholding rates higher as they were set in the beginning of 2025. Because of this, when we look to 2026, many more taxpayers will be receiving more refunds and higher refunds than they saw in the prior year. There's some estimates of basically another significant, an average about $500 per tax refund will be increased. So long story short is that more tax refunds, more people will receive tax refunds and a larger tax refund. That is strong economic stimulus. And if we did some quick back of the napkin analysis that said, if you look at all the potential tax refunds, the potential increase in tax refunds, that likely adds about 0.5% to GDP in the first quarter because we take this money and we spend the money. And it potentially adds about 0.8% to GDP for the first half of the year. This is economically positive. So again, by the IRS not reducing tax rates that they should have, this creates a higher amount of money taken out of our paychecks. This creates a higher tax refund. Another thing to think about is that, we saw a big surge of pre-tariff imports, because companies were basically importing tons of goods in anticipation of tariffs. But now they've sort of dissipated, and now they've seen inventories have come down dramatically because companies are using these inventories on their shelves to kind of sell and push out. One thing is interesting. If you look at this chart here, this is a simple ratio. It's inventory divided by sales. So if the line is higher, that means there's more inventory. If the line is lower, that means there's less inventory. And you see on the far right-hand side, inventory to sales ratios are pretty low. This is very supportive to the economy because, as we all know, companies need to rebuild inventory in anticipation of sales. Great number here. This is very pro-economy positive. The good news here is that wages are outpacing inflation. And this will help consumers like you and I adjust to higher prices. You see on this chart here, the green line is wages, and you see the light blue line is inflation. Wages, while they're coming down because the labor market's slowing, which we'll talk about later, wages are still above inflation. That's good news for the economy. Another thing to think about why we're very supportive about the economy in 2026 is that the Fed is still cutting rates. Yes, there's some debates in terms of how many times the Fed will cut rates in 2026. Will it be a lot? Will it be a little? At the end of the day, it's an cycle. This is so very important. We talked about this before, but remember, the Fed has a dual mandate. Number one, they want to make sure we all have jobs. Number two, they want to make sure inflation is kept in check. If the labor market is slowing, if people start losing their jobs, as we know, the Fed lowers their primary interest rate called the Fed funds rate. By lowering this rate, in theory, borrowing costs, credit card rates, home equity loan rates all start to come down, becomes cheaper to borrow money, and this in theory stimulates the economy. So good news, the Fed is cutting rates. Whether they cut rates a lot or a little, they are in a cycle where they're cutting rates. This is good for the economy. This provides a tailwind to the economy as it becomes cheaper for businesses and for you and I to borrow money to buy things. Good news for the economy. Now, if you look at this chart, one thing that people are always worried about is the fact that credit card debt is at all-time highs. This kind of makes sense, though, because the economy is growing and one would expect debt to be at all-time highs. But it's also very important to look at credit card debt relative to income. So if you look in these charts, there's two charts here. The top chart is household credit card debt. It is rising because we are in a rising economy and people are spending money feeling good. Chart. This shows credit card debt as a percent of disposable income. Yes, debt has risen, but relative to the long-term average, and you see the horizontal line average, debt relative to income is still pretty low and still pretty below average. This is very supportive of the economy. If these numbers were surging dramatically, it'll be very worrisome because people are over leveraging themselves. But debt relative to income is still pretty manageable. Another looking also at debt, let's look at household debt relative to GDP. And again, GDP is our economic growth. So you take debt divided by GDP. You see a very similar result. Debt has come down relative to economic growth. So yes, we have a lot of debt, but the good news is debt relative to our overall economy is pretty low right now. Because basically, since the great financial crisis back in 2008, remember the whole mortgage, all that mortgage stuff that went on? You can see that households have been deleveraging debt and deleveraging their massive amounts of debt since the great financial crisis. And you see the great crisis is that big gray bar in the middle. Since then, we've been deleveraging our credit card debt. That's a good sign of stability for the economy. So the consumer, you and I, we spend a lot of money. The consumer, as we spend about 70% of GDP is consumer spending. And so one thing we have to make sure as a consumer, you and I are doing okay. If you look at this chart, especially on the far right-hand side, you can see that retail, a good, very frequent measure of consumer spending, is picking up steam, especially as we head into the holiday season, especially as we head into 2026. Consumers, you and I, were spending, retail spending growth is really rising. Another positive for the economy. The big overhang is, what about the housing market? Yes, the housing market is slowing down. Yes, it's been a drag on the economy. Housing has been tough because we have very low inventory. We also have had very high mortgage rates. And you see on the right-hand side where you see home sales have fallen dramatically. But the good news is that housing is starting to flattening out a bit, especially as the Fed continues to cut rates, especially as interest rates come down. We do expect mortgage rates to pull back a bit further, helping to support the housing market. Housing is not on a all clear signal right now, but it is stabilizing. And if it does improve, which we do believe it will, this creates a tailwind. So taking everything together, the consensus is that the economy will grow in 2026 like it did in 2025. A little lackluster, a little mediocre, a little but positive. We do think it is underestimated. We do think, given fiscal stimulus with the tax refunds, monetary stimulus with the Fed cutting rates, economic growth picking up, wages over the housing market starting to improve. Take these and the other examples I mentioned, we do think the economy proves to be a little bit stronger than expected. And why do we care about the strong economy? Because if the economy is stronger than expected, companies earn more money because they sell more stuff. If they earn more money, investors tend to be attracted to the shares of those companies. So it's very important for the economy to be pretty strong. So the second theme is that we do expect below average equity returns. So as I mentioned before, the stock market, the S&P 500, has averaged about 9.3% since 1933. And if you look at sort of our projections for returns for 2026, it's not good, it's not great, but it's okay. We do expect returns probably in the mid-single digits, maybe 4, 5, maybe 6%. The economy looks stronger. Earnings, which I'll talk about later, look pretty good. But the problem is that market valuations are extremely high, which we'll cover a lot later. When market valuations are high, they price in everything to perfection, and no mistakes, no hiccups, nothing can affect the stock market given high valuations, and that's what worries us. So if you look at this chart, from a seasonality standpoint, we are entering the second year of President Trump's presidential cycle. Regardless of who's in power, whether it's a Republican or Democrat, historically what we've seen here, especially on this chart, since 1960, the stock market returns in the second year of a presidential term have averaged only 2%. That's that second bar from the left. So the first year, second year, third year, and fourth year. So you see here the second year of the stock market tends to be pretty poor the second year of a presidential cycle. So seasonality, you tend to see a tough year in the second year. One of the reasons why we think stock market returns will be lower than expected. Also, we think about the economy. The economy may do better than expected, but there still are some overhangs and some challenges. Right now, investors are really increasingly worried about the labor market. You look here, for example, this is jobless claims. Initial jobless claims are really low right now, but the labor market is tightening as companies are not hiring as much. So we do expect jobless claims, people filing for initial jobless claims could start to increase, which could pressure the economy as people start to lose jobs. Another reason, another way to look at this is the unemployment rate. So you look here, here's the unemployment rate. So this is basically the number of people unemployed divided by our working force population. And you see in the far right-hand side, we are at a cycle high. While it's pretty low, the unemployment rate here is around, let's just say 4.5%, 4.6%. It's pretty low because historically, when I was in school, we learned that a normal unemployment rate is about 6%. But 4 to 5% is extremely low. But remember, the cycle low is about 3.4%. So the unemployment rate is rising ever so slightly. Something you have to be careful of because the employment picture is what is the backbone of our economy. Another reason why we could see a little less market returns. Now, if you look at this slide, it really isn't just government employment showing slow. Always talks about the government is laying off people. If you look at the overall private employment, if you strip out healthcare, you can see that private employment growth is really trending poorly. So this chart has a lot of data going on. But if you look at it carefully, this chart shows private employment growth excluding healthcare. And healthcare has been a big surge in terms of hiring. And you look at the line, the light blue line here, you can see that private employment, excluding healthcare, has fallen dramatically, falling below its long-term average. So, long story short, the employment picture, while it is good, it is solid right now, it's starting to weaken a bit. The good news is the Fed is addressing this by cutting interest rates. When the Fed cuts interest, mentioned before, what happens is that borrowing costs for companies come down. When borrowing costs come down, companies can expand and spend more, and in theory, hire more people. The other thing to think about, okay, so the economy, while we think it'll be better than expected, it still has some overhangs, especially the labor market. The other thing to think about is that equities, when you and I buy stock, equities now have competition, especially for those investors, looking for especially for those investors looking for equity yield. They tend to either buy bonds or stocks. You see here very carefully are two lines. The dark line is the bond yield of the bond market, basically the Barclays Aggregate Bond Index, and it's around 4.5%. The light blue line is the dividend yield for the S&P 500. Historically, these two are linked very, very closely because there's always that decision. Do I buy a bond to get income, or do I buy a stock that pays a dividend yield? And they tend to be pretty close. Now, as a bond yield at a higher number is extremely high. So that creates more competition for investors looking for yield in the financial markets, potentially putting pressure on stocks that buy yield. Long story short, it's just another investment opportunity to get yield beyond dividend stocks. The overall good news is that while we think equity returns will be a little bit lower than expected, we still are very constructive. If you think about this, we've come off of 3 great years for stock market returns. So in 2023, we're up over 25%. In 2024, we were up over 25%. And think about that. That was the first time we've had 2 over 25% stock market gains since 1998. And then last year, or this year, 2025, we're likely going to come in around 14, 15, 16% for the stock market. So we've had 3 very, very good years. So with that in mind, the good news is that the markets are saying opportunity and very optimistic on a go-forward basis. One way we can measure this is something called the high yield spread. The high yield spread is a spread of riskier bonds relative to treasuries. And that's riskier bonds are called high yield bonds. If the markets feel good about the economy, feel good about very low recession risk, feel good about everything going on in our financial markets, they tend to bid down the riskier bonds. And so the yield of a riskier bond, a high yield bond over treasury starts to come down because there's less need to pay for additional risk, I guess, another way of putting it. It's called the high yield spread. And if you look here on the far right-hand side, the high yield spread of high yield relative to treasury is about 2.95%. Is that low? That's extremely low. The long-term average is about 519 or 5.19%. All this says is that high yield spreads are very, very narrow relative to the long-term average. The financial markets think things are going to go really, really well. Another point is productivity is such an important component in terms of market and economic expectations. So productivity is simply this. A rise in productivity is you have the same number of people producing more stuff. So the same number of people producing more and more stuff. It's a very important indicator because historically speaking, every time productivity rises, like it is right now on the far right-hand side, every time it's risen, we've exited out of a recession. So if you look at this chart going to the far left, all those gray bars are recession. And what you see, if you look carefully, the line has moved right after those recessions. So productivity is a very important indicator in terms of that we are exiting out of a recession. So let me give you a simple example. And I love using this example. So I live in California. I live in Santa Monica. So let's just say I am a manufacturer. I manufacture Santa Monica, license plates for tourists. So I manufacture these tourists. I'm a small business owner. Let's say all of a sudden, we have hit a recession. All of a sudden, business slows down, the economy slows down. So what do? I go down to my factory floor and I unfortunately have to lay people up. I tell my workers, listen, the economy is slowing. We have a recession. I have to let some of you go. It's awful. It's terrible. It's really, really detrimental. Then over the course of time, we have fiscal stimulus. So the government provides stimulus to businesses. We have monetary stimulus. The Fed lowers interest rates, again, going back to their dual mandate, and the economy starts to pick up. So what happens is that people start to call me and say, Gene, I want to buy some of your Santa Monica license plates. I heard they're the best in Santa Monica. So what happens is that I start to get business starts to improve. But I'm a small business owner. What the problem is that I don't know if we're out of recession yet. So what do? I go down to my factory floor and I say, listen, everyone, your jobs are fine, but business is picking up. I can't afford to hire people. So I need you to work longer hours, I need you to work weekends, I need you to produce more. I need productivity to rise. So that's exactly what's going on right now. Productivity is surging. Parts of it are AI, parts of it just people working more hours. This is a sign to us that we don't have a recession anytime soon. But more importantly, this is a sign to us that we already had a recession, just that the recession was so mild, we just never felt it. And I've said this before, but my best guess is that we had a mild recession in March of 2023 during the banking crisis. But again, this is such an important chart. Productivity is rising. As I mentioned before, earnings drive stock prices. If a company generates more earnings, investors tend to be attracted to the shares of the companies. If you look at this chart, look on the far right-hand side. Look, these are earnings estimates for 2026. The first bar, the green bar, is the S&P 500, so large cap companies, then mid cap companies, then small cap companies. Earnings look pretty good, especially when you look at the prior years. Earnings look pretty good. There could be some fluctuations here and there, but at the end of the day, right now, earnings estimates look pretty good. This is very supportive of the stock market. Again, why we do believe stocks will be positive in 2026, but not nearly as strong given high valuations. And then last but not least, productivity. Corporate profits are extremely strong. This is profits as a percentage of GDP. The corporate health right now is overall very strong. So with that said, the first theme is the economy proves to be stronger than expected. The second theme is that markets are positive, but not as high as their long-term average. And that last theme is really related to the fact that there's still some concerns about the labor market, still some concerns that we've had a huge market run, also some concerns that we are in the second year of a presidential cycle. Our third theme is simply this: leadership changes. So as I mentioned before, the last few years, market leadership really been AI, technology, all those big mega cap companies. And the rest of the market has had a hard time keeping up. We do believe the market dynamics that we're seeing right now, we do believe that the market leadership is going to change. Other parts of the market are going to move higher. And let me explain why. So if you look at this chart, first and foremost, let's just set the stage. This slide shows that in the S&P 500, that big stock market index that I talk about, the top 10 names, this is going to blow your mind. The top 10 names, there's 500 companies in the index. The top 10 names are 42% of the index. 10 names are 42% of the index. What worries us about that is that one of these mega cap names can have a mistake. This could impact the overall indices. This is why you need to sit down with Feller Financial and their advisors to make sure that you understand how diversified you are within your portfolios. Another thing to look at is that valuations. So here's the PE ratio, the price earnings ratio. So the price earnings ratio, let me take a step back. It's a very common valuation measure. It's the price of the stock market divided by earnings. If the number is higher, stocks are more expensive. If the number is lower, stocks are cheaper. Look on the far right-hand side. The PE ratio is over 41 for technology. And you go back in the chart, you can see it has never been anywhere close to this. Stocks are extremely expensive, or technology stocks, and most of these stocks are the ones that have led the market the last few years. So these are very expensive. The rest of the market, I have better valuations, which I'll show you in a second. If you look at this chart really shows the valuation of the market relative to the overall market. It's a complicated chart, but please bear with me. So there's two lines. The green line on the top is the PE ratio, remember, price earnings ratio of the overall stock market. The overall stock market. But then if we take the stock market and we say, you know what, instead of having the bigger companies being a bigger part of the index, we take the data around a little bit and we say, okay, let's say each company in the stock market, the 500 companies, instead of being, bigger and smaller weights, they're equally weighted. And that light blue line is equally weight. This is another way to show how's the overall health of the stock market. You see the valuation on an equal weight stock market is much lower. All this says is that the stock market is being driven higher from a higher valuation from those mega cap, aggressive technology, artificial intelligence names. But the rest of the stock market, that equal weight, as you see there, valuations are pretty attractive, especially compared to their history. Then if you look at this chart takes large cap, mid cap, and small cap. So the top green line is the valuation of large cap stocks. Very, very expensive. But the rest of the stock market, the mid caps and small caps, so large caps are the biggest ones, mid caps are a little bit smaller, and small caps are smaller than mid cap. The small and mid caps are looking very attractive from a valuation standpoint. And remember that chart I showed you before about earnings growth? The small and mid cap companies with the lower valuations are having higher earnings expectations than large cap. So all this together says the stock market has had a huge run. It's been really led by those really large AI technology companies, but the rest of the market we likely see will do better. And one last point I forgot to mention, historically speaking, when the Fed lowers interest rates, remember they're lowering the interest rate to stimulate the economy. Historically speaking, we've seen strong performance from small companies and mid companies, those companies in those lower valuations there. So as I kind of wind down, listen, our three themes are simply this. Number one is that the economy proves to be stronger than expected. Number two is that the stock market returns, while positive, will be lower than long-term average. And number three, market leadership is going to rotate away from the technology and AI companies. We still love AI, we still love technology, but valuations are so high, expectations are pricing and everything to perfection. We do think the other parts of the market will start to do well. So as you, as a client, as an investor, as someone working with Feller Financial, question is, what do I do? And I'm going to give you two words of wisdom, two pieces of advice. Number one, be diversified. I know it's been the last few years, everyone's been like, oh, we got to buy those AI companies, the technology companies. Yeah, it's okay to have some of those in your portfolios, but have exposure to other parts of the market, some value companies, some small companies, some mid-cap companies. So be diversified, have exposure to different parts of the market because not everything moves up in the same direction. You need diversification. The second thing is make sure your portfolio is not too aggressive or not too conservative relative to your long-term objective. You don't want to be too aggressive because that adds too much risk, nor do you want to be too conservative because then it's harder for you to keep up with your long-term objectives and goals. What do? The second thing is make sure you're in contact with your financial advisor. Make sure you're in contact with Feller Financial. Let them know if there's any changes in your life, your lifestyle, anything that's going on in your life, because they need to make sure your portfolio is aligned to your long-term objective. It's so very, very important. So with that said, I just want to thank you. I really want to thank Josh for letting me be part of this and speaking to you. I really want to thank Feller Financial. I do need to show you these disclosures. I will not read these word for word because I know you can read them yourself. I do need to show you these. But with that said, I really want to thank you for the time today to discuss the economy and the markets. And I apologize for my voice. I'm still getting over something right now. Thank you so much and make it a great day.
We truly hope you enjoyed and came away informed and are excited for 2026. If there's anyone you know that may benefit from our services, send them our way and we'll be raffling off a gift later this month. Thank you very much and have a great day.